Welcome to Finance, Accounting and Banking, specifically the final or financial statements. Final or financial statements are those records that are prepared at the end of the financial year or accounting period of a business. And those records are the trading account, the profit and loss account, the balance sheet, the cash book, the trial balance, etc. A trading account is a final statement of a business prepared to show trading results of the business. And those results are gross profit and or gross loss sustained by the business. It records the direct expenses and revenues that relate to purchase of goods or sale of goods by a business firm. In other words, the trading account gives details of total sales, total purchases, and direct expenses relating to purchase and sale of those goods. So, a trading account shows the results of buying and selling. It's only the manufacturing and trading firms that deal with sale of goods and purchase of goods. Service providers do not sell goods or purchase goods as their main business. Therefore, it's only the manufacturing and trading entities that prepare the trading account. So, service providers do not prepare this account. A trading account is the first step of final accounts. The main objective of preparing a trading account is to find out gross profit and or loss suffered during an accounting period. It is a nominal account, therefore, all direct expenses are debited and all direct incomes are credited in that account. It includes the opening stock, purchase, closing stock, and expenses relating to purchase and factory expenses that are recorded on the debit side. And on the credit side, sales and returns of the same are recorded. The credit side is heavier than the debit side, usually, and that would give us a gross profit. But if it is less than the debit side, we will realize a gross loss. Importance of preparing a trading account. It is necessary for a business to know the result of buying or manufacturing and also sale of goods in a particular period of time. Hence, it is necessary to ascertain the gross profit or loss. The main importance or objectives of preparing a trading account are: 1. To know gross profit or gross loss. 2. To provide safety or gross loss. 3. To provide information about the direct expenses. And 4. To have comparison of stock with the stock movement as well as the ending stock in a business. Advantages of preparing a trading account. 1. It shows the relationship between gross profit and sales, which help to measure profitability position of the business. 2. It also shows the ratio between cost of goods sold and gross profit. 3. It provides the information regarding efficiency of trading activities. 4. It makes it easier to compare between sales, cost of goods sold, and gross profit. 5. It helps provide information regarding closing stock, sales, and cost of goods sold. 6. It is a very important statement from the cost point of view of the goods. By preparing the trading account, entities can take decisions for continuing or discontinuing a certain product or the whole business. So, it helps to earn the maximum profit and reduce the losses. 7. With the help of a trading account, the sales tax authorities can easily see the correct purchases and correct sales as per the sales tax return submitted by a firm. Items recorded on the debit side of the trading account. 1. Opening stock. This is the stock that is brought down from the previous period. Remember, when we prepare these accounts or financial statements, we still are in trade, and by the time we prepare, there is stock that is in the business. That is opening stock for a certain period. Then you have purchases. This is the value of the stock that you buy within a given year. Then you have purchases returns. These are goods that are returned to creditors because either they are defective, they are not the ones that we specified as we were ordering, or such like reasons. We have direct expenses like carriage inwards or carriage on purchase, when you transport what you have bought to bring it to the business. You also have closing stock. This is the stock that remains unsold at the end of the year or accounting period. We have cost of goods available for sale. These are the goods in the business that can be sold during the year. What you opened with as stock plus what you have bought during the year, less what has been returned to creditors in or from the business. Then cost of goods sold. This is the actual cost of goods that we then sold. Items recorded on the debit side of the trading account. We have sales, what you have sold, actually the total value of the goods that you have sold. Sales returns or returns inwards. You may sell defective goods or extra goods or goods that have not been ordered for. You reduce that from your sales. The format, as we've said, there are some items that are on the debit side and items that are on the credit side. The title has 3 lines. The name of the company or business, then the term trading account, and then the period or the time you're preparing that account, because you have different accounting periods. So on the debit side or left hand side, you have opening stock. You add purchases, and from purchases you do other adjustments. You add carriage inwards or transport to bring in those purchases, and you deduct sales returns outwards or purchases returns. You had purchased goods but you don't need them, you return them to creditors, you reduce that, then you get net purchases. So opening stock plus net purchases, you will arrive at cost of goods available for sale. That is the goods that were available to be sold during the year. Then you remove closing stock. When you remove closing stock, you will remain with the cost of goods that were sold, that were actually sold, how much they costed you. Then you compare that with the sales. When you sell, you obtain revenue, but then you may sell some items that are defective or that are not the ones that were ordered for. So when you remove that, you get net sales. You compare net sales with cost of goods sold, and you arrive at gross profit. If the net sales are less than the cost of goods sold, you will obtain a gross loss. An example, the following trading balances relate to Johnson Limited, extracted on 31st December 2013. Stock at the end, 31st 12 2013, 294,000. Carriage outwards 20,000. carriage inwards 31,000, return inwards 20,500, return outwards 32,200, purchases 1,187,000, sales 1,851,000, discount received 19,000, salaries and wages 362,000, discount allowed 30,400, insurance 36,800, and stock at the start January 2013 236,000. Required: prepare the trading profit and loss account for the year ended 31st December 2013. We'll just prepare a trading account. When come to profit and loss account, we will prepare that. So the answer: Bandari Enterprises trading account for the year ended 31st December 2013. Look at the three lines: the name of the company, the title of the account, and then when you are preparing that. On the debit side, we have opening stock, the stock that we received from 2012 that had not been sold in 2012. Then we add that to purchases, and we also add carriage inwards, the transport cost to bring in those purchases, to arrive at a figure that we can call the purchases cost, which is 1,218,000. Then we deduct return outwards, those items that we returned to the creditors. They were defective or we didn't order for that. We will get net purchases. When we add opening stock and net purchases, we get cost of goods available for sale. These are goods that were available to be sold that year. Then we deduct closing stock, 294,600, to arrive at cost of goods sold. How much did it cost us? The goods that we sold, how much had it costed us? And then we compare that with sales. We made sales equivalent to 1,851,000, and we deduct sales returns or returns inwards, those items or the value of those items that have been returned to us, because after selling they were returned, so we cannot say that we sold them. We deduct that so that we get net sales. In our case, it is 1,830,500. We compare the net sales with the cost of goods sold, and in our case, the net sales are larger in amount than cost of goods sold. We will get a gross profit, and then we balance the figures. So this gross profit will then be worked on in profit and loss account to arrive at net profit or net loss for the year. Thank you for watching the video. Remember to subscribe to my channel, Edward Kariuki Mathenge, Kariuki Eddie 2010.